The global economy suffered a number of huge shocks, and policymakers, both central banks and governments, have struggled to deal with the aftermath. And as a result, some countries have fared very well, others are struggling and will continue to do so. So in this video, we look at the forecast from the IMF to see how that's likely to play out, but also look at this trend of political fragmentation to see how that's going to affect things like inflation, but also policy rates. This video is sponsored by Trading 212, a UK-based commission-free investment platform. So let's look at the global economic forecast in a bit more detail. The global economy suffered a triple blow. The first one was the pandemic, the second one was Russia's invasion of Ukraine, and as a result of those two, we had a cost of living crisis, which has affected much of the world. But let's start with the good news, which is that growth has slowed but not stalled. If we look at the forecast for developed economies, but also emerging economies for the next 2 years, you can see that there has been a slowdown, and we are well below trend, the long-term trend, but it's still not a case that we're going to have a global recession, say. If we look at global growth going back to 1980, you can see that the average growth rate, the median in fact, has been around 3.4% over that period of time. That's the dashed yellow line. But if we look at the forecast from the IMF, that's from 2023 to 2028, you can see it lies below the median growth rate. So certainly not a disaster in terms of growth, but it is a weak period. Now, there are three factors shaping the current situation, but also the years ahead. The first one is that we had a huge fall in services, which drive a lot of developed market economies, but now that slump in service activity has largely recovered. For example, if you look at the tourist industry, it's pretty much back where it was pre-pandemic. The second big theme is that central banks all across the world have been raising policy rates, interest rates, very aggressively. And this has hurt mortgage borrowers, but also other rate-sensitive parts of the economy. Now, in countries where we have adjustable rate mortgages, or ARMs, that's hurt the most. In the UK, for example, you tend to fix for fairly short periods of time, whereas in America, you can fix a mortgage for 30 years. So if you do have a lot of adjustable rate mortgages, the pain of higher policy rates has been felt sooner. And the third theme, which has affected the shape of the crisis, has been the cause of inflation. In countries which are heavily dependent on imported energy, the commodity shock that we had in 2022 pushed up inflation hugely. And now we're seeing the second round effects of that in terms of wage growth. That in turn is affecting services inflation, which is proving much more sticky. Now, countries in Europe which depended on Russian energy, here I'm thinking particularly about Germany, for example, those countries suffered a particularly damaging episode in terms of that price shock. Contrast that with the United States, where the inflation shock was driven much more by a very tight labour market. Now, this video is kindly sponsored by Trading 212, which is a UK commission-free investment platform. And it's not just about low fees, they're also very innovative. They've got lots of great features like fractional shares. If there's a very expensive share, you can just buy a tiny proportion of it. They also have pies where you can invest in a portfolio within a portfolio, and then to rebalance that set of stocks or funds, you just click one button. You can also share your pies with other people, or alternatively, you could use other people's pies as inspiration for your own. For general investment accounts, which aren't an ISA or a SIP, you can also invest in other currencies. So for example, you could hold dollars in your account or euros, and then trade in those currencies. And you can also earn interest in those currencies. Now, as a viewer of PensionCraft, you get a special offer from Trading 212 where you can claim a share worth up to £100. Simply create a new account on Trading 212, verify it, fund it with at least £1, and then use the promo code, which is my name, RAMIN. And you can also find out more about that in the description beneath me. But what we are seeing in developed markets is a divergence between the US and Europe. Now, the US certainly suffered economically during the crash in 2020, but it came out of that very strongly and continues to grow extremely strongly. And the IMF expects that that trend will continue over its forecast period to 2028. Compare that with France, the UK, and Germany, and those three countries are kind of languishing in the dust behind the United States. So at the Fed's monetary policy meeting in November of 2023, you can see Jerome Powell talking about how strong the US economy has been. Economic activity has been expanding at a strong pace, he says, and well above earlier expectations. Third quarter GDP is expected to have risen at an outsized annual rate of 4.9%. One of the reasons Powell gives for the unexpectedly strong economy in the United States is that they underestimated, the Fed did, how much people had in savings, but also how much companies had in savings during the pandemic. Here you can see those cumulative excess savings. However, they are now starting to be run down, particularly in the US, and eventually that's going to allow monetary policy to be much more effective. People could carry on spending despite higher interest rates because of those savings, and if you take them away, that's going to reduce economic activity. Contrast that with the UK. Here's Andrew Bailey talking at the Monetary Policy Committee in the UK the day after Powell talked. And the Bank of England is forecasting that UK GDP will be flat over 2024, essentially no growth at all. But despite a small recovery, from 2025 onwards, growth still remains below historic averages. And that's partly because of restrictive monetary policy from the Bank of England, but also due to subdued potential supply growth. The IMF also expects a divergence in growth in emerging economies. And unfortunately, the divergence in EM is to do with the largest EM economy, which is China. And in particular, the problems are centered around the real estate market there. This makes up a fifth of the Chinese economy, and we've seen a very severe slowdown over the past year. So here you can see a slowdown in real investment, but also housing starts, creation of new projects for housing, but also final sales. That's also a problem for the rest of the world, particularly commodity producers. That includes countries like Australia, but also South Africa and Brazil, which export raw materials to China to fuel that construction activity. So this problem isn't just contained to China. That's why it's probably the most important real estate market in the world. Now, after a big economic shock, the problem is that things don't always recover to where they were before the shock. This is called scarring. The yellow line here is the trend extrapolated by the IMF for the global economy before the pandemic. The other two lines you can see are more recent forecasts for the global economy. Notice that those are significantly below the trend that we saw pre-pandemic. So that's what we mean by scarring. How much has GDP fallen away from that long-term trend? And if we break it down by country, the greatest negative impact, the greatest scarring, has been in low-income developing countries. That's what LIDC stands for. EMDE stands for Emerging Market and Developing Economies. They've also been significantly negatively impacted. And of course that includes China. What you can also see is that in developed markets, EA, which is the euro area, has been more negatively impacted, more scarred than the United States, which has hardly been scarred at all. Now let's turn to inflation, which is causing a great deal of economic pain globally. Again, let's focus on the good news, which is that inflation seems to have peaked. So in the top graph, you can see headline inflation. That includes energy and food prices. The shaded grey region includes 50% of the economies around the world, and you can also see some individual lines for the largest economies. What's pretty clear is that the rate of inflation seems to have peaked around summer of 2022, and it's been steadily falling since. More worrying perhaps is that core inflation, which you can see in the bottom panel, that strips out volatile food and energy prices, that seems to be more sticky. And that's because of inflation in services, which itself is driven by wage inflation. So these are the second round effects which you often hear central banks talking about. Now, many households have been doubly impacted by this inflation spike. Firstly, money doesn't go as far as it did because you're having to pay more for just basic things like food and energy. Secondly, the monetary policy response has been to massively increase interest rates. So if you are paying a mortgage, that's going to become more expensive to fund if it's not fixed for a long period of time. Now, if you think that interest rates are going to come down soon so you can remortgage, you might be waiting some time for that to happen, as you can see in this extrapolation from the IMF. By the beginning of 2026, there will be a big fall in those rates, don't get me wrong. However, it's not going to fall to the near zero levels that we saw before the pandemic. So that's the central case. Now let's turn to the risk cases. In other words, what could go wrong? And the first risk we'll look at is sticky inflation. If we plot the course of the distribution of inflation numbers across the world, starting at the bottom of this graph, which is just after the inflation rate started to spike, all the way up to the top of the graph, which is July 2023, what we see is that initially inflation was low and fairly tightly packed, around 0 to 5%. Then we had a huge blowout of high inflation, so the distribution has a huge long tail stretching out to some countries which have inflation of 20% or more. Then from the summer of last year we saw it compress again, but nowhere near to where it was pre-pandemic. So if we add two vertical bars showing where we started, you can see that the upper tail of inflation is still very dispersed. It's still got some countries with very high inflation. And in these countries, policy's taking longer to affect the economy and to get inflation back under control. One of the reasons why inflation's been so sticky is that unemployment has remained very low. Now that's good news in a way because it means that we're not worried about job security. It's a bad thing also because it means that wage inflation has become a real problem. Usually when you get a recession, higher unemployment means that people don't demand such high wages, and wage growth falls very rapidly. We haven't really seen that, and the tight labour market that we do see, with low unemployment and lots of jobs available for every unemployed person, has meant that inflation has remained much more sticky, particularly core inflation. And that in turn means that policy rates are going to be higher for longer. So this is still a risk, that inflation remains stickier than expected, and that tight labour markets persist until we get a good old-fashioned recession. Another risk is that China causes contagion as its real estate market implodes. We're all familiar with the news stories about Evergrande, the Chinese developer which is going bankrupt, but so far the problems remain pretty much contained within China. Furthermore, it's remained fairly contained in the property sector. However, China's soon going to face some pretty difficult choices. So its policy response, which will be very tricky to pull off, will be to restructure these developers in a timely manner, but also to fix the strains in local public finance. A lot of local governments are funded because of sales of property to these real estate developers. So central government is going to have to plug that gap in funding. If it doesn't manage to avoid a huge fall in prices, then this is going to affect balance sheets at banks who have loaned money to these property developers, but also individual households who've also indirectly lent money to property developers. But it's not an easy solution because if property prices are propped up by the government, then it means that crowds out investment in more productive things. So that could slow GDP itself. Another risk is that governments carry on spending and that fuels further inflation. In other words, a mistake in fiscal policy. Here we can see the countries which spent a lot during the period of the pandemic, that's between 2019 and 2022. So the ones which spent most relative to GDP are on the far right of the graph. That would include countries like Japan, the Philippines and Thailand, but also Canada and the UK and developed markets. And then the vertical axis shows you what the IMF expect is going to be the slowdown in that spending. And that's over the period between 2022 and 2024. Now, generally the pattern is that countries which spent a lot during the pandemic are now cutting back more. That's why the line trends upwards, the dashed blue line. What the IMF highlights is the United States. That's a country which did spend a lot in terms of GDP, but it's also not cutting back on that expenditure over the forecast period. So that spending, that government spending, will be inflationary and is pulling in the opposite direction to monetary policy from the Federal Reserve. That could make inflation more sticky, more persistent, and mean the Fed has its work cut out for it and it has to keep rates higher for longer. Of course, the US is not alone there. You can see there are also other countries which are in that same quadrant as the United States, and they could stoke inflation in their countries too. And the final risk we'll look at is trade fragmentation, which is also inflationary. So if we look at the number of trade fragmentations over time and break it down by sector, you can see that that's surged recently. And that affects several types of commodity. It includes agricultural commodities, but also energy and minerals, and in fact all goods. Recent examples include the United States cutting exports of some high-end chips to China, and then China's retaliatory measure, which was to stop exports of some of the raw materials used to manufacture chips. So this is exports of gallium and germanium. What do we mean by fragmentation? Well, what seems to have happened is the world split up into two different trading blocks, as they're called. And you can identify those blocks according to the UN vote on invasion of Ukraine. Some countries voted to condemn that invasion, some didn't, and some abstained. The ones which voted to condemn the move are shown here in blue, the ones which refused to condemn it are shown in orange, and the much bigger category is shown in grey. These are countries which abstained or didn't vote. So the two blocks you can see here are pretty much split between the Far East, but also Africa. And then in the other block, we've got North America, much of South America, most of Europe, and also some of the Middle East. And you can see those blocks and how they've affected trade in oil very clearly in this graph, which shows you where Russia's exports have increased since 2019 and where they've decreased. Decreases are shown in blue, and those decreases have occurred to countries which voted to condemn Russia's invasion of Ukraine. And most of the increases in oil exports from Russia have occurred to countries which failed to condemn its move. And there in particular, we can see exports to India and China, which have increased a lot. In summary then, it's not all bad news. It's certainly the case that many economies across the world have been more resilient than expected. And that's partly because the labour market in most countries has remained very strong. Unemployment has stayed low. But what we are seeing now is a divergence between some countries and others. The US is looking pretty much like a soft landing, although that's not guaranteed, whereas the EU is still lagging behind in growth, and China's got its own particular problems with its credit-inflated real estate bubble. And while inflation is coming down, it is looking like core inflation is pretty sticky, and central banks are having quite a problem trying to get core inflation to fall. More worrying, perhaps, is that we're seeing tail risks in the form of geopolitical risk, which is very unpredictable. That in turn is impacting trade, and that's also inflationary because it restricts the supply of commodities, but also other goods and services. Now, as an investor, if you invest in global indices, because the US is kind of unscathed, because the US makes up about 55 to 60% of global indices, stock indices, then you'll probably not feel a lot of this pain. But I probably would keep away from having a big tilt towards emerging markets or perhaps to Europe at the moment, certainly if this forecast turns out to be accurate. And if you do want to see an example of a portfolio that does fairly well in all economic conditions, have a look at my video for Trading 212, which I did based on the all-weather portfolio. And don't forget the offer from Trading 212. If you use the promo code, which is my name, RAMIN, you'll get a free share worth up to £100. You just have to create and verify a Trading 212 account, fund it with at least £1, and use that code. And, as always, thank you for listening.